Hey everyone, welcome to Sum Zero. Today we have Ryan Williams as our guest of honor, CEO and founder of Cadre, located here in New York. Ryan, it's awesome to have you on. You may not know this, but I actually, or you may not remember this, but I actually met you. Uh, this must have been back in 2015, 2016. It was one of these like Harvard and tech events
Yeah.
where you were one of the speakers. And I remember at the time thinking, this is a pretty cool idea, kind of making commercial real estate investing more accessible to individuals. And it's funny because I like I have a fair bit of real estate exposure in my own portfolio, but it's just through residential real estate, not commercial. And I some of my friends have emailed me in the past about, hey, do you want to get in on this commercial building? And it ends up being this kind of mess of coordination, trying to figure out how much equity to put in, and how it's all going to work out. And the other end of the spectrum I also found to be somewhat limiting because traditional private equity is pretty there's a pretty there's kind of a tall hurdle to even being eligible to make an investment through a Blackstone real estate private equity fund or any of these other traditional private equity vehicles that focus on real estate. So, I guess let's start off with just your background. Would love to hear how you got the real estate bug. You've obviously worked in real estate private equity at Blackstone, but just curious, kind of tell me about a little bit about your career trajectory, kind of where it began, and what led you to creating Cadre in the first place.
Yeah, definitely. And I do remember the meeting. It seems like, or the introduction, it seems like a long time, a lot longer than 6 or 7 years ago. And so, but it's good to reconnect. Yeah, so, I founded Cadre in 2015. And as you mentioned, Cadre was really born out of my recognition that investing in private real estate was tedious, it was costly, and challenging, even for institutional investors. And, I'd had enough exposure to the real estate world, both from my time at Blackstone, but even prior to that, to see that it was walled off. The best real estate opportunities were challenging for almost everybody to access. And I also had enough exposure in the technology world through some other experiences prior to launching Cadre to realize that technology could be a great enabler and frankly the right medium to ensure more people could invest in the very kinds of private real estate that I was investing in at Blackstone and before. And so I built the business, founded Cadre to level the playing field, to let individuals and institutions invest alongside each other in one of the most important asset classes to build long-term wealth. And in many ways, since I founded the business, much of that vision has been realized. There's still a long way to go for us, but we've been incredibly proud the fact that we've invested across the country in real estate that exceeds more than $3.5 billion of value, that we've delivered north of 18% net IRRs to our investors. And we have a number of other realizations on the horizon as well. And so we've been able to allow thousands of people to invest in either individual deals or in curated portfolios, the same way that they can access stocks, bonds, and other products. And we think that this is an important product for people to have a truly diversified portfolio and ultimately to make alternatives less alternative.
I think that's a really great way of putting it. So can you just, maybe clarify the target audience for Cadre, just how that may differ from, again, the Blackstones of the world and some of the larger shops?
Definitely. So, our target audience are individual investors. Specifically, we've focused on qualified purchasers and accredited investors. But the progression of our journey and of our target audience sort of started at the top of the investing ecosystem, so to speak, which is one of the key differentiators in how we've approached expanding access to private real estate. When I started the business, we initially focused on enabling family offices and institutional investors to be able to invest in either individual deals and single sort of asset properties. As we continue to build track record, as we proved our model that enables investors to invest with significantly lower fees than traditional funds, more transparency, greater liquidity. We had some family offices approach me and say, you know, love this deal by deal investing model, but can we invest programmatically? Because they recognized diversification was key to long-term outperformance. And so we said yes. We launched a separate managed account program, raised more than $300 million in capital, including getting a meaningful commitment from Goldman Sachs Asset Management. And most recently, we launched a fund vehicle so that people can now either pick and choose or invest in our programmatic fund offering. And the beauty of this fund offering is that it's allowed us to go further down market. So, you know, we started at the top of the investing pyramid with larger institutional type investors, but now investors can invest across a portfolio of 10 to 15 assets for as little as $50,000. And so we are squarely in the high net worth accredited investor market, which is to say a key step in our progression of ultimately opening up access to retail investors at even lower minimums as well. But the short answer is our target market has been the individual investor segment, specifically qualified purchasers and accredited investors. But in short order, we will be opening up access and truly leveling the playing field.
So for accredited folks, I think going through the fee structure is important here, just because folks are fairly familiar with the 2 and 20 model, but how are you guys set up? Yeah, just maybe at a high level, what is the basic fee for your typical accredited investor?
Yeah, so it's a great question. And in the fee model, the economics of the traditional real estate fund model, I've always thought were excessive. And that realization was one of the drivers of me founding Cadre. As you know, I worked at a large real estate private equity firm prior to founding Cadre. And I could never really square the fact that investors who were able to invest in traditional real estate funds had to pay multiple layers of fees, what we called the double promote, sort of the 2 and 20 at the fund level. And then in real estate, what's unique, which is also a little bit of a hidden secret here, is that there's also a promote that the operating partners who are running the properties day to day charge. So as an investor in a fund, any of the major funds that I'm sure a lot of your members are familiar with, you're oftentimes paying 2 layers of promote, 2 and 20 that the fund manager charges, and then the 2 and 20 that the property operator charge, which can be incredibly punitive to returns. So one of the key innovations with our model is that we've eliminated the double promote. There's only 1 layer of promote and carry in our model. That's at the operating partner level. We share, we being our investment team, in a percentage of that 1 layer promote. But investors should take comfort in that we are significantly lower. And again, it can range anywhere from 20 to 35% lower in fees than traditional funds, because we've eliminated that double promote. And there's 1 layer promote. So investors will pay a performance fee, 1 layer, and then an ongoing asset management fee, which is in line with what market is. But on an aggregate basis, again, we are able to offer investors access with pretty meaningfully lower fees than traditional real estate funds charge. And I think our performance is borne out that lower fee model can still generate incredibly compelling returns across the commercial real estate landscape.
And I'm assuming your customers, they just go directly to Cadre, or do they go through like a private wealth group at a Goldman or
It's another good question. I mean, we've also innovated on effectively the direct to client model as well. So today, the majority of our investors actually come directly to Cadre. They log into our platform. They hear about us, whether it's through partnerships. For instance, we just announced that our alma mater, Harvard Management, invested in our latest fund product, and then they can sign up, and with the click a few buttons, either invest in individual properties, and we can talk about which markets and strategies we actually pursue,
Yeah.
or in our fund offering, our more actively managed product itself. Now, what's interesting is that we've seen a significant uptick in the number of registered investment advisors and private wealth managers who are approaching us as well. And so they also can bring their clients into our products as well. And there are beneficial economics to them for doing that. Goldman Sachs, for instance, committed more than $250 million in capital a few years ago on behalf of hundreds of their clients. So people can either come directly to Cadre or come through their financial advisor. The benefit to coming through their financial advisor or wealth manager, primarily an economics benefit in terms of paying even lower fees. And we have a user experience through our technology platform that enables easy oversight of those clients' positions across either individual deals or in our actively managed.
So I wanted to clarify one thing. Are you saying it's cheaper for me to go, or any client to go invest in a Cadre real estate deal through a financial advisor rather than doing it as a solo actor?
On the margins, it is, and that's just because we provide financial advisors and aggregators slightly reduced fees, discounted fees based off of their AUM, right? So if you invest more than $1 million, there's certain fee breakpoints. And so on the margins, it is. I wouldn't say it's a returns mover, but we know that a lot of our clients do have advisors who want to also ensure that they're helping manage their investments as well as cross-sell to other clients that they work with.
That's awesome. I mean, I think what's cool is that, an individual investor, say like myself or a family office, that's not a Harvard University, in theory, could invest in the same real estate asset as a large university endowment on similar terms.
That's exactly right. Yeah, and that's the beauty of what we've been able to build. And that was always my vision. I worked at Blackstone and I saw just how much wealth was being created. I also saw how important private commercial real estate was to building a portfolio that could withstand turbulent times. And I wanted more people to be able to benefit and invest the same way the largest institutions have been able to do. And so what we've been able to do that's unique is bring together the preeminent institutional investors alongside individuals, let them invest side by side in the same kind of product, and ultimately build the same types of wealth, which is really the genesis of the business.
On the subject of volatility and turbulence, how do you guys handle, a post-COVID world where folks are just not going to the office as much? Is that handled just through diversifying the holdings outside of cities or urban areas, or I guess how are you guys thinking about that?
Yeah, no, it's a good question. In terms of just the post-COVID world and commercial real estate broadly, I believe that there was a lot of concern, rightfully so, about how commercial real estate would be impacted given all the changes that we saw in the world. And we at Cadre really decided to take a kind of defensive pose over the last year or so. We knew that it was most important that we were focused on active asset management and active investor management versus trying to make any kind of new investments. But it's often said that when things seem crazy and most uncertain, it's also when it's best to be an investor, and that if you want to achieve unconventional returns, you oftentimes have to do unconventional things. And so we decided that we'd play defense through Q3 of 2020, but then shift our focus to offense faster than others, and capitalize on the dislocations and opportunities that we knew would arise coming out of this market uncertainty. And what we're seeing now is that things have recovered faster than any of us thought was possible. We're in a very different market now. And we feel like in terms of the property types we've invested in, we're seeing kind of unparalleled growth in those industries. If you think about where we're investing, multifamily, industrial, life sciences, office, those are all asset classes that pre-pandemic we're seeing some unique tailwinds. Post-pandemic, those tailwinds have accelerated significantly. And so just like in any other asset class or any other space, We believed that commercial real estate would have winners and some losers. We focused on assets where we felt like there was a defensive nature to them, plus where they would see unique acceleration. And now as we look at our portfolio, we're not pretending like we were prognosticators, but we are saying that we've been really pleased with the performance. Occupancies at our multifamily assets are at all-time highs because, as you know, single family pricing is pretty crazy. A lot of people can no longer afford to buy homes, and so they're staying in multifamily apartments longer. And so renewals and occupancy and rent collections have stayed incredibly healthy. Industrials, another asset class we've invested in. E-commerce has accelerated tremendously due to COVID, and tenants are now looking for faster, cheaper delivery times to population hubs. And so we're actually building like a distribution center in the Phoenix, Arizona area, one of our top 15 markets, to capitalize on that dynamic. And then within office, which is sort of the third food group we focused on, we had never invested in the major cities, the CBD infill markets, because we couldn't justify what people were paying to buy office assets in New York and the like. But what we did focus on were, suburban nodes, high quality assets where we thought they were good value buys, where there's easy access to amenities. And now we've seen a lot of those suburban office assets rather see significant growth as well. I mean, there was one asset in the Greenwich, Connecticut market where we were for a couple of years struggling to lease up square footage there. We now have multiple family offices that have approached us about setting up satellite locations there. And then within office, beyond the suburban niche, we've also focused on life sciences. And I don't need to go into much detail there in terms of the tailwinds with all the R&D in light of the vaccine.
So, yeah, this is a funny anecdote. I just moved to Greenwich. It is impossible to find a nanny out there.
There you go. You go. Yes, exactly. One of my wife's best friends moved during the pandemic from the city to Greenwich as well. And we're expecting, and we reached out to her about her nanny, and her nanny's been quadruple booked. So it's growing, and
she's got her own office space.
Right.
Yeah.
Exactly.
So on the subject of deal sourcing and just your acquisition process for properties, like who's behind that at Cadre? How big is that team? What are their backgrounds? What are they looking for? Is there some kind of internal return hurdle that you guys have? Anything you can, if you can get any color there, that'd be super helpful.
Definitely. Yeah. So another one of the key differentiators that we've been able to bring to bear at Cadre is really the combination of domain expertise from both the real estate world and the technology data science worlds. Because I had experience at some of the preeminent financial institutions, Goldman Sachs, Blackstone, I was fortunate to see what excellence looks like in terms of underwriting and investment rigor and criteria. And, I knew that was something I wanted to bring to bear in our business as well, because, it had to be a team that would be incredibly rigorous, institutional plus in their underwriting and deal selection. And then I saw the benefit of technology and data science and how that can help augment the traditional investing process. So we've been fortunate to bring together folks from both worlds. On the real estate side, we have more than 40 investment professionals who are full-time employees that work across acquisitions, so sourcing of opportunities, asset management, oversight of those opportunities, and disposition and sale of those opportunities. We've been able to bring some of the best talent in the space. You think about someone like Mike Fascitelli. Mike was previously CEO of Vornado, one of the largest REITs in the country, and then head of Goldman Sachs real estate group. Mike chairs our investment committee. He's been with our business for more than 6 years and was one of my first partners to support us. Our head of investments is a guy named Dan Rosenblum, who formerly ran acquisitions at Gem Realty, a Chicago-based real estate PE shop, was at Fortress. Our president is a guy named Alan Smith. Alan used to be the president and CEO at Four Seasons Resorts and Hotels. Prior to that, he was the CEO of Prudential Real Estate globally, now PGIM. And then we have a number of other professionals as well. And so you have one of the best teams in the industry sourcing opportunities with a network of more than 300 operators around the country, underwriting, investing alongside our investors. And then when you couple that with a world-class data science team, where we're able to identify markets that will be markets we believe will drive out performance, and augment asset management so that we can make dispositions, refinancing sales. You build something that looks very akin to a next generation real estate private equity company, but it's one that doesn't come with the traditional costs and opacity that exists today in the space.
That's awesome. On the data front, I mean, I don't know if you can be too specific about the type of data you have access to, but I'm assuming you're assessing macro trends and I don't know how populations are moving or things to that effect. But what sort of data are you generally relying on to spot which markets are going to expand or contract over the medium to long term?
Yeah, so we've spent the last 6 years developing a number of macro models, and we like to employ sort of the 80-20 rule. We spend about 80% of our time proactively sourcing new opportunities in those markets. And if you go to our website, we call it the Cadre 15, our top 15 growth and affordable markets in the country. And what we've been able to do is build a proprietary set of indices that allow us to better understand pricing activity across those markets. If you think about how the S&P measures the appreciation of a basket of stocks, our indices help us measure the appreciation of each market. And if we know where the market is going, it's done historically rather, we have a much better view as to where it might be going. And so one example of that is Phoenix, Arizona. It was one of the markets we identified in our Cadre 15 more than 4 years ago. And it was a market where we saw that there was a ton of inflow from California, a lot more affordability, pretty robust job market. It was diversifying outside of a few sectors that had historically been the drivers of growth in Phoenix. But affordability was incredibly high. And we doubled down. We made a decision to build a platform and invest in a number of assets there. And now if you look back on Phoenix, it's one of the top 5 growth markets in the country, and it's only accelerating. And so we like to think of the data science efforts as augmenting that sourcing and investment process, giving our team just a lot more confidence. And we've also been able, besides data science front, to build tools internally that allow us to ingest data from public third-party sources and then proprietary sources, because we've built our own management software. So we have access to more than 400 million macro, fundamental, and asset level data points that we ingest, which again gives us just greater confidence when we're looking at making bets in certain markets. And ultimately, what that will demonstrate, and the success of our efforts will be best demonstrated rather in performance. And so far, again, we've been able to outperform NCREIF and every other major index in a pretty meaningful way.
Is there a cap rate threshold that you will not, where you will not invest in a particular building or market if rate, if you're not seeing, a certain cap rate?
Sure.
In that
yeah.
market?
So we have because real estate has been so micro for us and hyper local. We don't have a broad range of cap rates at the market level. I mean, we've seen certain apartment complexes, might be a newer build, trade 25, 50 basis points wide or tight rather of something built 5 years before. But what we do focus on are returns and total returns. And so generally we're targeting low to mid double-digit net IRRs. Historically, it's been closer to low to mid-teens net IRRs to our investors, with roughly half of the return coming from cash flow. And as I mentioned, historically, we've outperformed those benchmarks, north of 18% net IRR. In terms of asset class focus and how we think about our fund product, which is a good kind of representation of a holistic portfolio investing view, within multifamily, which is roughly half of what we will be investing in and have invested in. We're generally looking at low, call it 10 to 12 or 13% net IRRs or above. And then what we're doing is we're kind of coupling that multifamily foundation with more opportunistic investments in life sciences and industrial, where we can generate high teens type net returns. So on a blended basis, again, you're in that low to mid double-digit return. And from a cap rate perspective, if we were to look at cap rates across our portfolio, I would say that 6 months ago, a lot of our multifamily deals we would be acquiring in that kind of 5% plus or minus 25 basis point cap rate range. But that's come in 50 to 75 basis points even over the last 6 months or so.
Wow.
And so it's been a ton of value appreciation, and our portfolio has benefited, and investors have benefited because they've been able to participate in a number of those opportunities in our current fund.
So the current fund, is this the $400 million fund, or was it, well, I got to do that right? Is there a lockup associated with that?
Yeah, so in terms of the Cadre Direct Access Fund, which you're referencing, our initial target was 400 million. I think we will far exceed that. The lockup period in terms of when you're not able to sell or get liquidity is basically up to and through the deployment of the last asset, which we expect to happen sometime in kind of Q2 of 22. After Q2 of 22, investors in our fund will be able to actually achieve liquidity through a secondary marketplace, which is another novel feature we've built on a quarterly basis. And we expect distributions to happen thereafter as well.
So you guys built your own secondary marketplace?
Yeah, one of the major innovations that we've developed is the industry's first secondary market. When I was thinking about founding Cadre, when I thought about the fact that even the most sophisticated individuals that I knew didn't have access to the premier private real estate, I recognized that there were really two key barriers. One was low fee access, to individual private real estate, commercial real estate deals. The other was lack of liquidity. A lot of people just weren't comfortable with having their capital tied up for 5, 7, 10-year hold periods. And so I thought that if we were able to build an institutional platform in terms of selection, performance, but one that was more transparent, fee light, and liquid, then we could help level that playing field. And so we started developing our secondary marketplace 6 years ago, and we launched it a few years ago. And since we've launched it, we've seen hundreds of LPs be able to trade with other investors. And a lot of investors who have sold or traded have been doing so for personal liquidity reasons, or because they want to reallocate or rebalance into our fund or portfolio offering. I'm
assuming you guys issue K1s.
Yep. Right.
Yeah, got it. So now for the retail investor, the person who maybe isn't accredited, I don't know if you can disclose, but what's the general game plan for those folks who don't have whatever the minimum is? I think you mentioned $50,000. Maybe they have $10,000. How would that work?
Yeah, well, my vision has always been I want any individual to be able to invest in alternatives the same way the preeminent institutions have been able to. And so that's the key focus for us, which means reducing our minimums significantly from where they are today, because $50,000 is a big initial commitment. And I recognize that there's very few products that you're able to, or that you will invest in online, for 50K. We've still seen a number, hundreds and thousands of folks who are investing at those levels. But in terms of our plan to further open up access, we later this year will be planning on lowering our minimums in a meaningful way. And then in 22, we plan to further lower our minimums and accept retail investors into our products as well. But I've always believed that the right way to build a business is to develop brand equity, trust, scale with a very focused core group of clients and customers, prove the model. And from there, it's much easier to scale, much easier to open up access, especially in an industry like real estate, where historically people have been very much on the outside looking in. And so,
I completely agree. And I think your approach is very consistent with, I think your own personal ethos in terms of just expanding access to bringing this asset class to more people who like historically would never have had access to it. It almost reminds me of what we're doing at SumZero in terms of bringing, institutional level research to individual investors who would never have had access to it. Talk to us about the work you've done, with respect to community development and some of the, some of the work that's more focused on minorities and,
Sure.
and helping them, with access to capital and the like.
Absolutely. Yeah. I mean, everything that I've focused on and tried to spend my time and energy on has really had to do with leveling playing fields, ensuring that I can do my part to promote self-determination amongst the underserved, and that extends to our investment philosophy and approach as well. I mean, I believe what we're seeing, and you alluded to it, is really a new generation of investors that want to tear down the old walls that separated Main Street from Wall Street. And Cadre, we think we are going to be able to catalyze that. And so, as I mentioned, the Cadre Direct Access Fund is a vehicle that is going to offer and has offered investors access to opportunities at lower entry points than they otherwise would be able to participate in. And in our strategy within the Direct Access Fund, we've also been very focused on backing diverse partners. Real estate is incredibly homogenous, as you can probably imagine, like the financial services industry. And other than being the right thing to do in terms of partnering with women-led and owned operators and minority-owned and led operators, there's also an opportunity there that is a good investment opportunity, because many of these folks have been overlooked. Many of these operators are incredibly capable, and frankly, many have delivered alpha and outperformance. And so, as a part of our strategy within the fund, we are partnering with a greater number of diverse operators. It's something that a lot of people have talked about, not many people have executed on, and we are proud to be amongst.
What was the story that you, was a personal one with you investing in Atlanta?
Yeah,
well, I think you had applied for like 10 loans and got rejected everywhere except for one. What was
right? Yeah, no, that's right. So, I mean, the diverse operators is one vector dimension. The other is minority depository institutions, MDIs, which are financial institutions, primarily banks that are minority owned. And so that's deeply personal. We'll be partnering with a number of MDIs, largely because when I was in college, I started a real estate business during the subprime credit crisis timeframe, buying single-family homes in the Atlanta metro area. And I really wanted to take the next step in my growth to start buying apartment communities. We had a great track record. I had a ton of strong investors behind me, a lot of classmates who had a lot more liquidity than I did.
That's
and
great.
to apply to buy a couple of large apartment complexes in the Atlanta metro area. And I was turned down by 11 separate banks. The reasons I was turned down all varied, but they were all underpinned by you are a quote unquote risky borrower. And I interpreted that to mean, I'm different. And so as a result, I didn't fit a certain pattern.
Were you like 18 at the time, or how old were you?
This was 11 years ago. So I was about 20.
20. Wow.
So, but, I had...
Yeah, I was not buying apartment buildings when I was 20.
Right. You were involved in some entrepreneurial endeavors at
Harvard. Yeah, I did some stuff too.
But yeah, so you get, just like the network there and the opportunity there. Right. So I had a lot of classmates with more liquidity, parents who had a ton of capital who were standing behind the loan. So it wasn't like we didn't have the credit. It wasn't like we didn't have the credit, but I was told that, we wouldn't be able to get a loan. The last hour, Citizens Trust Bank, which is a Black-owned bank in Atlanta, Georgia, founded in 1921. Actually, Martin Luther King Jr. was an advisor. Coretta Scott King was on their board. Very community-oriented, gave me the loan and said, we believe in you. We ended up doing pretty well and almost doubling the money to those investors. But had I not had that institution back me and take a chance on me, I might not be here today. And so I haven't forgotten that. I recognize that There are a lot of other folks who haven't had opportunities, who are incredibly capable, who have the grit, have the capabilities and the work ethic. And, we believe that through our platform, we can also help level the playing field for them as well and do good for our investors, which is always our number one focus.
That's incredible. How long did you own those those apartment communities? What was just curious what the whole.
Yeah, it was about 3.5, 4 years. And we bought it at a point in time, actually not dissimilar from the time we're in today, right? It was coming out of the subprime credit crisis. There was a lot of concern about real estate and will it ultimately hold up? And that was when we found the best opportunities. And I think that in many ways, our current fund mirrors a lot of the same types of strategies that I invested in back when I was just getting my feet wet in this space coming out of the great financial crisis.
Well, what's the saying? Trouble creates opportunity. So, no, I think that makes a ton of sense. What is the typical, I guess, concentration level in that you'd expect in the current fund? If I was to put, that 50,000 in there, how many different assets would be held in that fund?
Sure. So it would be likely 12 to 15 assets that would make up that commitment. And you would be diversified based off of asset class, geography, and operator base. Roughly half of what you would invest in would be multifamily, one of the fastest growing spaces and it's, again, one of those not so well kept secrets that, residential real estate, single family homes are incredibly expensive, but that's accruing to the benefit of multi. So you would get half of your investments in a fast growing asset class. And then the other half of what you'd invest in would be split between industrial, life sciences, office, and then potentially suburban office as well. But those three food groups, multi, life sciences, and industrial, would be the main asset classes you'd invest in. And it's important to note we only approve about 1.5% or so of the investments that we see. And so these have been curated, they've been vetted. I think our track record bears that out. And the last thing I'll say on this front is just markets are key. We've been very focused on the Southeast, the Southwest in particular, in terms of the markets we think there are significant tailwind, population trends, and explosive growth. And so if you double click, for instance, on three of our biggest markets, Phoenix, Austin, and Tampa, each of those markets have seen explosive population growth, 10%, 15%, 9% respectively. And then if you get even more micro, which is what we do, and look at the zip codes that we invest in Tampa, for instance, the zip code for a few of our assets seen more than a 25% increase in population.
You're doing some Palm Beach work?
Not quite.
Not quite.
but we're within the vicinity. I just say that to say you compare that to national growth to 3% the same time period, and you can see that just like in the equity markets, you can find these micro opportunities and great management teams, and you can drive out performance.
You're also getting the Joe Rogan, Elon Musk effect to add fuel to the fire.
That helps.
That's awesome. Would you say your view in the New York areas? And I know this is generalizing, but are you fairly bearish on kind of New York? As an investable asset. I mean, I only ask this is like I run a business. We have. We're an interesting case study. We're a fairly small team, but we actually got out of our lease last year.
Yep.
And we're always, kind of thinking like, when are things going to get better in New York? I'm born and raised in New York, so I'm always rooting for the city. But I'm curious what your general view is on New York.
I'm also a supporter and a believer in New York as well. And I think New York is exceptional and unique relative to a lot of other traditional gateway cities, whether it's SF or LA or otherwise. So my view on our view on New York is that New York will recover, it will rebound. A lot of this will follow the course of the virus and the variants, but there's some unique dynamics in New York that can't be replicated. The cultural diversity and vibrant, the population diversity, and the industry diversity as well. And so I do think people will return. I think people have seen that there's a lot you can replicate virtually, but there are still some things that just can't be replicated in terms of trust, relationship building, unless you're in person. And we see it, even at our company. We're staying in New York. We have an office presence in New York. We are hopeful to grow our footprint. But I do think that, New York brings enough dynamic and meaningful sort of cultural diversity that people will return. And then the final thing I would just say is, we're in the financial services space broadly. New York is still the beacon of financial services. And I think some of the greatest innovations that will be happening over the next 5, 10, and 15 years will be at the cross section of financial services and technology and fintech. And there's no better market than New York when you're looking to have partnerships and, figure out how to help some of the incumbents reach the next level of growth. And, anecdotally, one of our largest investors, Andreessen Horowitz, just opened up a New York office, right? So I think there's a lot of really exciting opportunities in New York specifically. I'm bullish. I think office landlords are flexible and they're figuring out how to repurpose space. I think you'll see a lot more life sciences in the New York office space. But that, I think, goes with just the underlying cultural dynamics that you have here and the diversity of industry that I think will serve us well and leave New York to have another comeback.
That's funny you mentioned Andreessen Horowitz. They're heavily into blockchain. Where do you see the intersection of blockchain and real estate?
Yeah, we spent a ton of time, on potential applications of blockchain in our model. If you think about what we're looking to do, fundamentally, we want to reduce the friction that comes with investing in this asset class. And I think if you're able to have a source of truth and a ledger, and a ledger that allows people to more easily transact, buy and sell interests in commercial real estate assets or any assets, then you can achieve great things in great scale. So I think there is a time and a place for blockchain and the application to alternatives and to real estate. I still think there's a lot that has to be worked out in terms of regulatory dynamics, legal dynamics. And like I told our team, even if we were to put a few assets, on the blockchain or enable people to put some of our assets in the blockchain, the underlying deal has to still work. It still has to be a good investment. Just because it's tradable or you can fractionalize interests down and let people more efficiently buy and sell doesn't mean that it's a good asset to be bought and sold. So my view and our view is that there will be an opportunity potentially for us to turbocharge our secondary market, leveraging the blockchain down the line. We're still a ways off from that, but we do believe in blockchain. We do believe in having one source of truth for people buying and selling assets. And we think it's a matter of when, not if, it's applied to our space and to other alternatives as well.
That's really interesting. So what would you say is preventing you guys from going beyond real estate into sort of more traditional private equity or just entering other asset classes? Like, why not build it out for, I don't know, buying hospitals or other,
Sure.
other assets?
Yeah, my vision has always been more expansive than real estate. Real estate is an industry that I know well. It's an industry that has been a very insider industry for a long time. And it's an industry that we think is a great beachhead for us ultimately to expand to other alternatives. Because when I look at, the thesis behind Cadre and I see that the average individual has less than 2% of their holdings in commercial real estate, the average institution is closer to 10% in real assets. I recognize that there's this huge discrepancy, that a lot of wood to chop. And so what we want to do is chop as much of that wood, narrow that opportunity gap, level the playing field. And as we start to see that gap narrowing, which I believe we're beginning to see, we will start picking our heads up and thinking about other asset classes that could complement real estate for our investors, because our investors aren't just real estate investors. In fact, most come in saying, I've tried to get into the real estate space, but I've looked at club deals and it feels like I'm getting adversely selected, and these funds are opaque and hard to fully understand, and REITs are correlated to the equity markets. But we want to have a one-stop shop for alternatives. And so that's our opportunity. My sense is that sometime in the next 18 to 24 months, we will start expanding the types of investment offerings and products, but we still have a good ways to go to make Cadre a household name as the gold standard for any individual or advisor looking to access private real estate. Until that's the case, we're going to focus on execution. We're going to focus on leveling the playing field in this space.
So maybe this is a good note to end on. In terms of competition, when you guys are deal sourcing and trying to, like, who are you coming up against? And do you feel like you guys have reached a scale or maybe a brand awareness at this point where landlords or sellers want to sell to Cadre versus, another potential buyer?
Sure. Yeah, we're and it's so interesting to like think back to when I founded the business. One, no one had heard of us, and we still have a long ways to go because we haven't done a ton in the way of marketing or like other folks have done. But one, no one had heard of us, and then two, there are questions about our ability to actually deliver on what we said we were going to be able to deliver on. So the number of operators that were excited to transact with us was limited. That's changed night and day in terms of people seeing us deliver, people seeing us execute on what we said we were going to do. And so now when we're going to win a deal, which we normally do in off-market transactions, we try not to get into auctions or bidding competitions or otherwise. People look at Cadre as the ideal capital partner. And the reason is because of our agility, the speed that we're able to move with. I always say, a fast no is sometimes better than a long yes even. And that's enabled just given our organizational structure, some of the principles and the values we have about moving fast and moving decisively. But I put up our speed against any player in the space. So velocity is the one thing. The second is we have a better structure in terms of a lower cost of capital. We're just much lower fee than any other traditional players in the space. And then third is, every single deal we do is structured on a deal by deal basis, right? So even within our fund, each deal has its one layer promote. And we think that creates better alignment with operators because, every deal stands on its own. Every deal has to perform well. We can't, have a fund with 10 winners and 2 to 3 losers. That just doesn't work for us given our structure. And so as a result, operators are excited because they know that they're going to get all of our energy and focus on each individual deal. So if we're competing against traditional real estate funds, we oftentimes will win. I can't think of a time recently where there's a price point we were comfortable that we lost the deal at. And most importantly, we've been able to structure a number of repeat programmatic partnerships with landlords and operators where, they know they have a template, they know they have a deal with us, and we've done repeat deals with an increasing number of these partners. And that's really what it's about for us. That's why the name Cadre was so representative of what we're looking to do. We want to focus on only the best investment opportunities from a select cadre of operators who are only focused on delivering value to the individual investor at scale. And so far, we've been able to deliver, and I think the future is pretty bright for us.
Well, Ryan, you beat me to it. I was going to ask you about the origin of the name, but you kind of filled in the blanks. Listen, this is great. I'm gonna have to think about this for myself as well as I
we'd love to have you
look at my own portfolio. But thanks for spending the time and walking us through the model. It's exciting to see, real estate being disrupted because, anybody who's had to rent in New York is familiar with the, let's say, stereotypical profile of like the typical New York commercial real estate landlord. So it's, you guys are a welcome addition to, to like the mix, I guess.
Thank you.
But we'll certainly be following up with you guys, and best of luck as you guys continue to expand the operations.
Thank you so much. We appreciate it.
Thanks, Ryan.
All right, take care.
Bye.